As a real estate investor, operator, or lender, you need to understand how to underwrite deals. I hear this all the time, and it's the wrong way that too many operators and investors rely on third parties that have zero economic interest in the deal. Who doesn't have an economic interest in a deal? A real estate agent, an appraiser, maybe another real estate investor that's helping you determine how much the property is worth. Okay, great. That's fine. I'm not saying take their opinion, not to take their opinion for what it is, but they don't have an economic interest in the property. So it's extremely important for the person writing the check, signing on the loan docs, or having an economic interest in the project to make sure that you are thoroughly underwriting all your deals. Ian and I are going to go through how the two of us underwrite our deals, and you're going to see two different perspectives: how he does it as an operator and an investor, and how I look at it as a lender and an investor.
Yeah, no, underwriting is one of the most important parts of the whole deal process. You can't make money when you sell the property. You make money when you buy the property, and that all starts with underwriting. So the first thing that I do when we start underwriting deals is I always do them on the back of the napkin. You don't want to get caught up wasting too much time, busting out these massive pro formas, Excel sheets, all these real estate investment calculators that everybody has before you even understand the deal. When I first underwrite a deal, it happens real quick. It usually comes in through my email. A broker calls me. I see something on MLS, Crexy, CoStar, wherever it may be, and I start painting a mental picture of this deal. I start understanding, like, hey, if I bought this, what kind of return would I need, right? Like quick math, $100,000 house, your return might have to be 10%. What can I get that rent that I need to make that $10,000 a year? So that's all I do. Everyone thinks that it's like, I got to get in the war room and I got to do all this stuff. Guess what? If you do all that, you're probably never going to do a real estate deal. Keep it simple, stupid. That is the most important thing you can do in the first step of underwriting. What do you do, Jason?
I agree. And it's very, very similar to what we do. What I am not doing is running out to the property. What I'm not doing is spending endless hours kind of putting together, hey, could we structure it like this? Could we do it like this? Could we do it like that? We stick to the basics first. I get on the phone with the borrower immediately, try to figure out exactly what they're looking for. And first off, if the numbers don't work for what the borrower is trying to accomplish, as a lender, the numbers probably aren't going to work for what we're in essence going to do, right? We determine approximately how much cash the borrower is going to need into the deal. Do they have the proper characteristics to be able to execute and the capacity to execute on the project? And one of the most important things is do we believe that this borrower is going to make money on a project? Because we don't want to be involved in a project that a borrower, in essence, is going to lose money on. That's not good for anything. It could be a fix and flip. It could be a rental property. It could be a bridge loan on a commercial asset or a rental property. But in essence, back of napkin, let's just go through the basics. Let's see if this deal has any legs first before we take it to the next level.
Yeah, everything you just said, those are all things that are going through my mind as a real estate operator and a real estate investor in other people's deals as well. After we've done through all those things, and there's a couple other things that happen. Like, look, this is not a super rigid process. It is very fluid. The next thing I like to do is call the broker, call the listing agent, call the wholesaler. Hey, is that deal still available? I have loose interest. And I know this isn't an acquisitions video. This is an underwriting video. But the last thing I want to do is go spend a ton of time underwriting a deal to then find out that the deal is already sold. So usually I just have a quick conversation, try to get some pricing guidance, try to get, again, building that mental picture, understanding of what the market might take or need to get this deal done. So this is kind of like step 1A, and then step 2 is what we're looking at. Step 2 is to sit down and do a hard underwrite of the deal. Sometimes it does take going to the property. Sometimes it does take sending a third party out there to go find out what's going on. But most of the time, it is the Excel sheet. It is past experiences that we have, pulling past records. It is putting hard numbers on the piece of paper to make sure that our pro forma works. And this is all before I ever call Jason or any other hard money lender or capital investor or any other bank to say, I want to borrow money. I always look at deals intrinsically without placing debt or investor capital into the deals. The deal as a whole needs to work on its own as if I was going to put all the money into the deal on my own. What's step two for you?
Yeah. So our step two again is still not going out to the property yet. Like you potentially said, our step two is jumping on MLS, pulling comps, doing research to make sure that this deal obviously has legs. When we underwrite, we're underwriting as the 4 C's, collateral being the first and foremost and the most important, right? And then we're character, capacity, and credit. So if it's a bad deal, it's a bad investment, there's no need to proceed. Again, we talked about step one. That was just determining if it's a live, real deal and if the borrower has the means to do it. Step two is more like, okay, great. Let me dive into this collateral a little bit. I'll jump on MLS. Now, obviously, residential stuff might be a little bit easier and quicker than commercial stuff. I recommend, and I get that there's a lot of difference and a lot of variance in this, so you don't have to follow my recommendations. But my recommendation is I like to invest and only lend in local markets that I know and I understand. That doesn't mean that we don't expand into other markets, but I'm going to learn and understand them and try to be an expert in those areas. So in essence, I can hop online, I can hop on MLS, I have other resources that I could potentially call if I needed help with it in those areas to determine, hey, if this is a deal that I want to lend on, like I can figure out what the average age of the property is to determine approximate cost per square feet to build. But in essence, it's very collateral based, determining if the deal itself works and if it's a good asset.
Yep. Yeah, that all makes sense. And you can see how Jason's process kind of lines up with our process. We're doing some more physical items than say Jason is, but he's the lender. I'm the operator. I'm trying to figure out how to make this deal. What competitive advantages can I get in step two? Step three for me is, again, not even getting the deal in contract. I'm not even worried about that. When it comes to underwriting, step three is where the fun happens for me. I've underwritten a deal. It makes sense on paper from a cash on cash return. Now I get to layer the debt in. Now I start having the conversations with the lenders. Hey, where's rates today? Hey, what do you think you're willing to lend on this? It also is, what kind of capital investors do I need? How much cash do I have on hand? If I put capital investor money in there, what type of returns do they need to see? Does the thing still cash flow? Side by side with that, guess what? If I put my own money in there, well, I need to have a certain return on my money as well, right? And I don't, too many real estate investors look at their capital and just say, whatever, it's a deal, I'm making this cash flow. Well, no, you need to remember that there's a lot of other investments that are passive that you wouldn't even need to work that hard, and you could get better returns without having to do all this hard work. So we're looking at deals. This is where the deal structure starts to come in. And that's a whole nother video that we'll do. And we'll probably post it up here in the channel at some point. But that is that's where the whole deal structure thing starts to come in place. That's step three for me. It's where the rubber meets the road. How are we going to finance and do this deal and make it advantageous for everyone involved?
Yeah, on our end, assuming the deal works and the borrower accepts our terms, if the borrower verbally agrees to our terms, they can make the deal work. They have enough cash to close. Then the deal goes from origination into processing / underwriting. We order title. We send our in-house inspector out to the property. These are things that potentially I would have done inside the business early on. Now we have, inspectors and evaluators that know exactly, that are our eyes and ears, that in essence can do that. So they're going out to the property. We're ordering property insurance. We're collecting docs from the borrower, potentially a bank statement, the ratified contract, their entity documents, insurance information, maybe a lease if it's a rental property. Obviously, if this was a commercial asset, we might order some sort of commercial valuation or an environmental study. We have resources and tools because we are a private lender, a hard money lender, that I don't have to wait 30 days or 60 days to do these deals. I can do residential stuff in a day or two, when clean title comes in, and commercial stuff in like 2 weeks, because I've got resources and I've got ways to get some of these studies done quick and easy. But that's when kind of the fun happens and everything kind of gets collected. What I've what I've learned, and this might be different than you, Ian, but what I've learned when a real estate investor, sophisticated real estate investor comes to us for a loan, they typically don't lie about something. They don't typically tell me they have good credit if they don't, because they know I'm going to pull credit, right? And that'll just change up the terms. They won't say they have $100,000 they can put into a deal when they have $10,000, right? So that makes it a little bit easier dealing with sophisticated real estate investors. But in essence, we collect all the information and get ready for closing and funding, and everything moves quick.
Yeah, and that all makes sense. And you can see Jason's step 3 is just a little bit ahead of where we are. And that's why I try to be transparent in step 2 and step 3 and having the conversations with the lender and saying, this is where I'm at. What do you think? Because you can see all the work that he has to do to get the deal across the table. Step 4 for me is something that's happening actually before step 1, and it's happening all the way through closing and all the way to even potentially selling the property, owning the property. Whatever we're going to do with the property is risk mitigation. That's the final step in all this. Is the deal I'm doing intrinsically good? What is my risk? What is my reward? What am I missing out on by not selling, by not moving, by doing this property? Sometimes if you do a deal, it might be a massive time suck and you might not want to compromise lifestyle. It might, but there's a massive financial reward, and that's something that you're willing to do. Sometimes doing a deal might be super easy, but there might not be a lot of cash flow because it just fits in your portfolio. Again, applying capital investor or your own capital into that deal, what other opportunities are you missing out on? Are markets changing? What's happening? Again, this is happening all the way through the process. And as you can see, I don't even have this deal under contract yet. I have barely talked to the broker all but 15 minutes to this point, whether it's a real estate agent, a commercial broker, or a wholesaler, or even direct to owner. Risk mitigation happens all the way from the time I look at a deal all the way to the time that we dispose of a deal. And if I had a guess, Jason, it's got to be a similar final step for you.
No doubt. And before I go through that final step, if you have any questions for Ian or myself, feel free to just comment them below in the section. We love this business. It's something that we're very passionate about. Just comment them and we'll answer them directly ourselves. So the final step 4 in our business is kind of putting everything together. All the due diligence items are coming in. We're reviewing everything. We're sending we're sending the file off after title work comes in to our attorney to do title review and to do doc prep. We're, in essence, dotting our I's and crossing our T's on the transaction, making sure everything that we were expecting was going to come in and look exactly as expected. And in essence, we close up the loan, and we close the loan. We wire the funds to closing. We obviously have underwriting checklists in place to make sure that they have proper insurance coverage, that we're wiring the money to the right title company, and we verify wire instructions and things like that. We have lots of checks and balances in place because you're wiring big sums of money. And the loan closes, the borrower signs their loan docs, we post close it, and we service the loan. And just like Ian doesn't truly get paid until he exits the property 6 months to 60 years later, maybe he's paid along the way. It's the same with us. Yes, we make origination fees up front. And we're making our interest rate of return and things like that. But I'm in that deal for the life of that deal. Just like if Ian's taking out debt or he's got a capital investor or a limited partner or somebody that's involved, he's in essence, maybe even on paper, he might not be liable for that debt, but in reality, he is, right? Because ethics, and that's how you become a real operator. So we're in that loan forever. And sometimes the best deal that you ever did was the one that you didn't do, right? And that happens sometimes. And we've passed on deals last minute. Ian's passed on deals last minute because something didn't come off right.
Yep. The power of saying no. That's a whole nother video. So guys, hopefully this underwriting has helped you and you can take the steps that you need to do to get your real estate investing career started, investing side by side with someone, and or just going out and doing your own deals and have a better understanding of the market. So hopefully this video was a help, and we'll catch you on the next one.